London, 1640. A merchant clutches a leather pouch filled with gold coins. He's terrified. Not of thieves on the street, though they're everywhere, but of something far more dangerous, his own king. King Charles has just done the unthinkable. He's walked into the royal mint where merchants stored their gold for safekeeping and simply taken it. All of it. Called it a forced loan. The merchant, like thousands of others, has lost everything he deposited with his own government. So he makes a desperate choice. He takes his remaining gold to a goldsmith shop. Not to buy jewelry, to hide his wealth from his own sovereign. Within a generation, this act of desperation will accidentally create something that changes human civilization forever, the first sustained European system of paper money. But here's the twist nobody saw coming, and the question that will haunt this entire story. How did craftsmen who made wedding rings and decorative plates become the architects of modern banking? And more importantly, why did their invention, born from royal betrayal, lead to the exact same crisis they were trying to avoid? The answer reveals something disturbing about every financial system that's ever existed, including the one you're using right now. To understand how goldsmiths became bankers, you need to understand the world they inherited. Medieval Europe ran on metal. Gold and silver weren't just valuable, they were money. You couldn't print more gold. You couldn't devalue it with a keystroke. A gold coin from ancient Rome spent just as well in 1600s London as it had a millennium earlier. This created a seemingly perfect system. Money had intrinsic value. It was universally recognized. It couldn't be inflated away. But it had one catastrophic flaw. It had to be stored somewhere. For centuries, the wealthiest merchants used the royal mint, the government's own facility, as a secure vault. You'd deposit your gold, get a receipt, and know it was safe behind the thickest walls in England. The system worked because everyone trusted one fundamental rule. The government wouldn't steal from its own vault. Then Charles I broke that rule. In 1640, desperate for funds to fight the Scots, Charles seized £200,000 in gold from the royal mint, about £40 million in today's money, but representing a far larger share of the total wealth in circulation. He didn't ask. He didn't negotiate. He just took it, promising vague repayment terms that everyone knew were worthless. The psychological impact was immediate and total. If you couldn't trust the king with your gold, who could you trust? Enter the goldsmiths. These weren't just jewelry makers. In an era before banks, goldsmiths were the only private individuals with three critical things: strong vaults to store precious metals, scales to weigh and verify gold purity, and enough working capital to conduct large transactions. They already had some wealthy clients who stored gold with them for safekeeping, paying a small fee for the service. After Charles's seizure, that trickle became a flood. But here's where the story takes its first unexpected turn. The goldsmiths didn't set out to invent banking. They were just trying to provide a storage service. They'd issue a receipt when you deposited gold, just a simple note saying, "I owe you this much gold, signed Goldsmith." You could come back anytime, present the receipt, and get your gold back. Simple, safe, straightforward. Except one goldsmith, we don't know which one, and that's part of the mystery, noticed something strange. It started with the receipts. When merchant John deposits 100 gold coins with goldsmith Thomas, Thomas writes him a receipt. Later, John needs to buy wool from merchant William. He could go to Thomas, withdraw his 100 coins, carry them across London, risking thieves, and hand them to William. Or he could just hand William the receipt itself. Think about what this means. The receipt says, Thomas the goldsmith owes the bearer 100 gold coins. It doesn't say Thomas owes John 100 gold coins. Anyone holding that receipt can claim the gold. So William accepts the paper instead of demanding actual gold. It's easier, safer, and Thomas's reputation makes it as good as gold itself. This is the birth of negotiable paper, the ancestor of every check, every banknote, every dollar bill in your wallet. Paper money had existed in places like China centuries earlier, but in London, This was the moment when transferable notes became the foundation of Western banking. But some anonymous goldsmith realized something else. Something that would change everything. Let's say Thomas holds 1,000 gold coins in his vault, deposited by various merchants. He's issued receipts for all 1,000 coins. But on any given day, how many people actually come to withdraw their gold? Maybe 50 coins worth. Maybe 100 on a busy day. The vast majority just sits there, untouched, because people are using the receipts as money. So Thomas thinks, what if I lent out some of this gold that's just sitting here? Or even better, what if I just issued receipts for gold that I don't actually have? Here's the revolutionary logic. If only 10% of people want their gold on any given day, I only need to keep 10% of the gold in my vault. I can issue receipts for the other 90%. I'll charge interest on those loans. As long as everyone doesn't come for their gold at the same moment, nobody will ever know. This is called fractional reserve banking, and it's not a bug. It's the foundation of every banking system that's existed since. But pause and consider what just happened. Thomas has effectively created money out of thin air. There are now receipts circulating in the economy worth 1,000 gold coins, but only, let's say, 300 gold coins actually exist in the vault. The other 700 coins worth of receipts represent what exactly? A promise? A collective belief? A lie? The answer is all three, and it works beautifully until it doesn't. By the 1660s, Goldsmith banking has taken over London's financial system. The advantages are obvious. Merchants love it. Instead of hauling gold across the city, they use Goldsmith notes. These notes become so trusted that they circulate as cash. Some goldsmiths even issue notes in standard denominations, £5, £10, £20, making them even more like modern banknotes. But the real revolution is in lending. A merchant wants to finance a shipment of tobacco from Virginia. In the old system, he'd need to have the gold up front or find someone willing to lend him their actual gold. But now, a goldsmith can simply write him a receipt for gold that doesn't physically exist. The merchant uses that receipt to buy his tobacco. The tobacco arrives, he sells it at a profit, and pays back the goldsmith with interest. Everyone wins. The goldsmith has earned interest on gold he never had. The merchant has financed a venture he couldn't have afforded otherwise. The economy has grown because credit, that magic word, has made new ventures possible. This is exactly what the document you provided discusses in the context of Canadian versus American banking, though from a different angle. It talks about how banking systems evolve to either concentrate or fragment financial power. But what it doesn't emphasize is this. Both systems, whether centralized or fragmented, were built on the same goldsmith's trick of lending money that doesn't fully exist. By 1670, the goldsmith bankers of London are the most powerful financiers in England. They're funding trade, financing wars, and even lending to the government that once stole from its own mint. The king himself now borrows from goldsmiths because nobody trusts the royal mint anymore. But here's what nobody's saying out loud. This entire system rests on one critical assumption. The assumption is simple. People won't all want their gold at the same time. In 1672, that assumption explodes. King Charles II, son of the king who started this whole mess, does something breathtaking in its audacity and stupidity. He declares a stop of the exchequer. He announces that the government will not repay its debts to the goldsmith bankers. Not today. Not next year. Maybe never. The irony is nuclear. The entire goldsmith banking system exists because Charles I stole from depositors. Now Charles II steals from the goldsmiths themselves, who had become the lenders keeping his government afloat. The immediate effect is panic. Several major goldsmith banking houses collapse instantly. Why? Because they'd lent heavily to the government, and now those loans are worthless. But remember, they only kept a fraction of their depositors' gold in the vault. They'd lent out or issued receipts for the rest. When depositors hear that their goldsmith is in trouble and rush to withdraw, there isn't enough gold to give them. This is called a bank run, and the painting described in your document captures it perfectly. One man gets his gold and walks away satisfied. The banker glares at him. Everyone else in line realizes with dawning horror that they're not getting anything. But here's the part that reveals something deep about human psychology and financial systems. The goldsmith whose vault actually contains gold, who's been conservative and kept higher reserves, faces just as much danger as the goldsmith who's been reckless. Why? Because in a panic, depositors can't tell the difference. They just know that some goldsmiths have failed, and they're terrified they're next. Your document discusses this exact mechanism in the context of American unit banks versus Canadian branch banks. The professor describes how American depositors, knowing their local unit bank couldn't diversify risk across regions, would panic at the first sign of economic trouble. The runs weren't irrational. They were rational responses to structural fragility. But the Goldsmith banking crisis reveals the deeper truth. All banking systems, no matter how structured, are vulnerable to this same dynamic. Because all of them are built on lending out more money than they actually have. The 1672 crisis eventually stabilizes. Some Goldsmith banks fail. Others survive. Life goes on. But the crisis exposes the fault line that will fracture every financial system ever created. So what happens next? How does society deal with this discovery that its entire banking system is built on a foundation of collective belief rather than solid gold? The answer is both ingenious and terrifying. They institutionalize it. In 1694, England creates the Bank of England. It's not a bank in the Goldsmith sense. It's a central bank created by government charter, with one explicit purpose: to lend money to the government. But here's the trick. It does this by issuing banknotes that are supposedly backed by gold, but are really backed by government debt. Follow this logic carefully. The government needs money. The Bank of England lends it to them. How? By issuing paper notes. What backs those notes? The government's promise to repay the loan. But where does the government get the money to repay? From taxes and more loans from the Bank of England. It's circular. It's absurd. And it works, as long as people believe it works. Over the next century, this system spreads across Europe and eventually to America. Your document touches on Alexander Hamilton's creation of the Bank of the United States in 1791, America's attempt to copy the British model. Hamilton understood that a national bank could coordinate credit, stabilize currency, and finance government operations. But here's where America's story diverges in a crucial way that your document explores in depth. America couldn't politically sustain centralized banking. The revolutionary legacy, the westward expansion, the rise of rural populism, all of these forces pushed toward fragmented local unit banking instead of nationwide branch banking like Canada developed. And this created a uniquely American form of financial fragility. Your document describes the 6 major banking panics between 1873 and 1907, crises that happened like clockwork whenever an economic shock hit during a seasonally vulnerable time for agricultural lending. These weren't caused by reckless goldsmith bankers. They were caused by structural fragmentation that prevented banks from diversifying risk or coordinating responses. But notice, whether you have centralized banking, like England and Canada, or fragmented banking, like the United States, you still have the same underlying vulnerability. Both systems create money through fractional reserve lending. Both systems are vulnerable to panics when people lose confidence. The difference is just how the panic manifests. In America, it shows up as frequent regional panics that usually resolve without massive failures, because the fundamental problem is liquidity, not insolvency. In other systems, you might have fewer panics but bigger catastrophic failures when they occur. The crucial insight from your document: the 1,873-1,907 American panics actually didn't cause massive bank failures. The 1893 panic, the worst of them, resulted in losses of just 0.1% of GDP. Compare that to the median banking crisis globally since 1970, 16% of GDP. That's not a typo. Modern banking crises are 160 times worse than the terrible panics of the Gilded Age. What changed? This is where the story gets uncomfortable because we're living through the consequences right now. Remember Argentina 1890 mentioned in your document? It's described as unique among 19th century crises because it was a twin crisis, both a banking collapse and a currency collapse. Why? Because the Argentine government guaranteed mortgages called cedulas, creating a moral hazard where banks made risky loans knowing taxpayers would cover the losses. Sound familiar? That's the 2008 financial crisis. That's the savings and loan crisis of the 1980s. That's every modern banking crisis that's left taxpayers holding the bag. Your document makes a crucial observation. Before World War I, banking systems were disciplined by two forces. First, market discipline. Depositors would withdraw funds from risky banks, forcing them to deleverage. Second, fiscal discipline. Governments committed to the gold standard couldn't bail out failing banks without risking currency depreciation. Both disciplines kept the Goldsmiths trick in check. Yes, banks created money through fractional reserves. But they couldn't go crazy because depositors would punish them and governments wouldn't save them. Then everything changed. The document attributes this to the rise of democracy and short-term electoral pressures. When elections loom and unemployment rises, governments face a choice: maintain long-term fiscal discipline or print money and bail out banks to postpone pain until after the vote. Guess which option wins? Since World War II, we've systematically dismantled every check on fractional reserve banking. Deposit insurance removes market discipline. Why would depositors monitor bank risk when the government guarantees their deposits? Abandoning the gold standard removes fiscal discipline. Governments can print money to bail out banks without immediate currency collapse. Too big to fail doctrine removes bankruptcy discipline. Large banks know they'll be rescued. The result? Banking crises that dwarf anything the Goldsmiths could have imagined. Consider the numbers from your document. 1893. American panic, the worst of six. 0.1% of GDP in losses. 1920 American agricultural crisis, entire decade. 1% of GDP Great Depression. 2.5-3% of GDP a median global crisis since 1970. 16% of GDP to some modern crises. 40% of GDP. We've built a system where the Goldsmiths' trick of creating money from nothing has been turbocharged by government guarantees, and the result is a financial system that's simultaneously more stable day to day, but catastrophically more dangerous when it fails. Here's the pattern that keeps repeating. Government protection leads to excessive risk-taking. Excessive risk-taking leads to crisis. Crisis leads to government bailout. Bailout creates expectation of future bailouts. Expectation of bailouts leads to even more risk-taking. Argentina in 1890 was the canary in the coal mine, but we didn't listen. So what are we supposed to learn from the goldsmith who accidentally invented paper money? First, all modern money is based on collective belief, not intrinsic value. That goldsmith receipt was only valuable because people believed they could exchange it for gold. Today's dollar is only valuable because people believe they can exchange it for goods and services. The system works exactly as long as the belief holds. This isn't a flaw, it's a feature. But it means the system is fundamentally psychological, not physical. Second, the invention that saves you from one crisis creates the next crisis. Goldsmiths emerged because royal theft made government vaults unsafe. Fractional reserve banking emerged because goldsmith receipts made lending easier. Central banks emerged because goldsmith failures made coordination necessary. Deposit insurance emerged because bank runs made saving risky. Each solution was rational. Each created new problems. The goldsmiths were trying to protect wealth from theft and accidentally created a system that enabled theft on a scale no medieval king could imagine. Third, the most dangerous financial innovations are the ones that remove consequences. When depositors could lose money, banks were careful. When banks could fail, bankers were cautious. When governments couldn't print money freely, fiscal policy was disciplined. Every time we remove a source of pain, we remove a source of discipline. The result isn't a safer system. It's a system that appears safe right up until it catastrophically fails. Your document makes this point brilliantly in discussing why Canadian banks coordinated to rescue failing banks in 1906 and 1908, while American banks couldn't. It wasn't that Canadians were more virtuous. It was that they operated in a system where failure had consequences for the survivors, so they had incentives to prevent failures. When government guarantees remove those consequences, the incentives disappear. So here's the uncomfortable question we're left with. Are we the merchants trusting the goldsmith, or are we the goldsmith writing receipts for gold we don't have? The answer is both. Every time you deposit money in a bank, you're trusting a system built on the goldsmith's trick. Every time you use credit, you're benefiting from that same trick. The system has generated incredible prosperity, just as goldsmith banking financed the expansion of trade in the 1600s. But the pattern is clear. The more we protect the system from failure, the more catastrophic the eventual failure becomes. The goldsmiths created something remarkable, a way to expand the money supply to match economic growth, rather than being constrained by the arbitrary supply of gold in the ground. But they also created something dangerous, a system that depends on confidence, that can amplify shocks, and that transfers risk from those who create it to everyone else. The medieval merchant who took his gold to the goldsmith to hide it from the king thought he was solving a problem. He was. But he was also creating the conditions for every banking crisis that followed, including the one we're building toward right now. Because here's the final disturbing parallel. We still haven't solved the fundamental problem. We've just moved it. In the 1600s, people worried about the king seizing their gold. Today, we worry about inflation seizing our purchasing power. It's the same theft, just slower and more socially acceptable. The goldsmith's accidental invention gave us modern prosperity, but it also gave us modern financial fragility. And unlike the goldsmith, we can't claim we didn't know what we were doing. We know exactly what we're doing. The question is, what are we going to do about it? If this story changed how you think about money, and it should, then you need to understand the full history. The next video in this series explores how this same pattern played out in the Great Depression and why that crisis was fundamentally different from the goldsmith panics we discussed today. The mechanism is the same, but the causes are opposite. You need to understand both. Subscribe so you don't miss it. And share this with someone who thinks they understand how banking works. They don't. None of us did until we understood the goldsmith. Money isn't what you think it is. And that's either the most liberating or the most terrifying thing you'll learn today.